Hello, everybody. Tortoise Investing coming at you today with 3 of the best stocks to buy now or keep your eyes peeled for if they aren't at your preferred stock price yet. Now, before we dive into those, we're going to take a quick look at my portfolio. This one I did do a little buy yesterday. Ulta Beauty did drop below $350, so threw 100 at it. I put 10 in Starbucks and I put 10 in Celsius. And this is how things are looking. Yeah, down a lot in Celsius. Know what I'm doing? Buying more. Price target was 65. It hit 65. I bought a little. And as it's been dropping more and more, I'm buying more and more. I think the portfolio looks really solid right now. Today is payday, so you can see how things go this morning. If there's any more dips in anything, stay tuned. Probably going to be some buy alerts this evening. I didn't send the one out yesterday. I was really busy at work yesterday. We were doing a lot of painting and stuff, and yeah. But before we get off topic, let's go ahead, hit that like and subscribe button. Don't forget, I greatly appreciate it. Let's keep on marching toward 2,000 subs. We passed 1,000, which is awesome. And comment down below. Do you own any of these that we're going to be talking about, or are you looking to buy anything? I'd love to hear from you. But yeah, let's go. First one, Amazon. Oh yeah, Amazon. This thing cracked the $200 mark here recently. Earlier in July, actually, this thing was up to $200. Over the last year, up 42%. Over the last 5, up 108%. Looking pretty good. Just free cash flow yields 1.27%. The reason that I've got my eye on this one now, they reported earnings yesterday, and as of right now, pre-market, they are down over 8%. This thing's down to $168. I like that. That's getting into the area where, like, I want it. I might start a position in it. I love Amazon. Google, same thing, same way. Absolutely love those companies. They are both just behemoths, absolute powerhouses. Revenue's been growing at a rate of 22% over the last 10 years. 10.61 over the last 2. So it is slowing, but still double-digit growth out of the revenue. Very, very nice. AWS, really big for them. As you see, this is also growing year over year. Free cash flow, look at that. That is just amazing. They're back on track with their free cash flow. They had a really tough year in 2021, 2022. They did a lot of CapEx spending during COVID and stuff to open up a bunch of warehouse centers and just hired a whole load of people. So they do have that under control. And as you see, this is great for them. Now, I think they do have quite a bit of stock-based comp. Yes, but as you see, it is outpacing. The growth of the free cash flow is outpacing the stock-based compensation, which I love. I hate when it's the other way around. The stock-based compensation is going up 100% every quarter, and the free cash flow is like barely going up. Another massive red day yesterday. Look at that. EPS in their area where they are excelling in again. 2022 kind of beat them up a little bit. Take a look at the quarterly to get updated debt. Debt is $132 billion. They got $89 billion in cash on hand. Not an issue. EBITDA is $85 billion. My general rule of thumb is I like companies that have more than 3 times their EBITDA in debt. That tells me if something major was to happen with the company, if they were to have some financial troubles, and they needed debt, it would hit them a little bit harder, be a little bit harder for them to manage. Shares outstanding. This is slowly going up and up over time. Hopefully it's something that they can start to dwindle down some and take better control of. I would absolutely love to see this be decreasing over time. I think we'll get there. They're generating enough cash flow to where I'm really certain that we're going to get there. Feel pretty good about it. Next up is NVIDIA. Forward divided NVIDIA. What am I doing? It's been a hot minute. Analyst estimates. Look at me. I'm all over the place here. Analyst estimates. EPS average growth 459, grown to 580, and the revenue is 638.81 billion, grown to 710 billion. So double-digit growth projected out of those. Now we can go to NVIDIA. NVIDIA. Down 6% yesterday. In pre-markets, down another 3%. I was told that I was crazy, that this would never touch back into the 100. Well, I think that it will eventually dip below 100, my personal opinion. We did hit 103 July 30th. It has been on an absolute tear over last year, almost 147% over the last 5 years, 2,600%. Jesus! But I think it's going to go below 100, personal opinion. Now, if you like it, you're a big fan of it, you think that it's going to prevail and be the king of kings, and as it continues to drop, have the mindset to buy more. Not financial advice, not saying to do that, not saying that you're going to be guaranteed to make $1 million billions if you do that, but I'm looking at this and I was like, okay, if this drops below 100, I'm going to buy a little bit. And then as it continues to fall, I will buy more and more. Because I think NVIDIA's got a great future ahead of it. I'm very long NVIDIA. And as you see, they're down 19% plus the 3.5 in pre-market. So NVIDIA's officially in a bear market cycle. Keep dropping, baby. That's all I got to say. Keep on dropping. Just free cash flow yield, 1.32%. Dividend is so itty-bitty. 0.03%. Takes up 0.9% of their EPS, whatever. Over last year, we're up 147%. I already went over this. It's nuts. Crazy. Annualized, take a look at the revenue. Explosive growth. Absolutely explosive. You're going to see that with the free cash flow as well. Just absolutely crazy. EPS can be the same way. They have $25.98 billion in cash, $31 billion in cash, and $8.46 billion in debt. It's better to look at NVIDIA at a quarter-over-quarter basis. This quarter-over-quarter, look at this. Beautiful. Revenue by segment. Beautiful. Look at that thing growing and growing. The free cash flow that they generate is just silly. EPS, same way. Shares outstanding. Look like they're nibbling at it slowly but surely. And return on capital employed is just absolute nuts, man. 59.8% is just crazy to me. EPS is 260, growing to 354, so very double-digit growth there. And revenues 120 billion, grown to 168 billion. Analyst estimates, so looking pretty good there as well. Next up, last but not least, we got Ulta Beauty, adjusted free cash flow yield of 5.12%. Love this company. Over last year, we're down 19.69. Over last 5, up 6%. Over last 10 years, though, I gotta have that long-term mindset. 270%. Beautiful. Revenue's growing at a rate of 15.42% over the last 10 years. Over 10% over the last 5. Number of stores opening is also increasing and growing rapidly. Love it. Free cash flow growing. Very, very nice. Over 10% in the last 5 years. We take a look at, let's see here. Is that, yeah, adjusted free cash flow. That is more than their normal free cash flow. It tells me they're buying back those shares. Yeah, do it. Like that a lot. The debt, they have 1.63 billion in debt. Cash is 766 million. Their EBITDA was 1.9 billion. So again, my rule of thumb, no more than 3 times their EBITDA in debt, not an issue. And the share buybacks, yes, over 2.59% over the last 10 years, 3.8% over the last 5. I love to see this. Yes. I hope that they're using all their free cash flow right now just to buy more shares. They started the year at 49.6. They're down to 48.3. And keep on nibbling that, especially on this drop, on this pullback. Return on capital employed has been wonderful for this company for a while. Even during COVID, they're at 24%. But yeah, since 2022 to now, we're setting over 40% with the ROCE, and it is beautiful. EPS, 23.13 grown to 25.68. So I think that's double-digit growth there. In revenue, 10 billion grown to 11.55 billion. So again, double-digit growth out of that as well. That is everything I got for you. Let's take a quick peek at Ulta, actually. Well, has it dropped anymore? See. I have to keep my eyes on that. Anyways, guys, that's everything I got for you. Hope you enjoyed that. Make sure to hit that like and subscribe button for more. And until next time, take care. I'm still here. See yous.